Hello, everyone. Welcome. We are so excited to have you here today. Thank you for joining us. I see people flooding the room. This is awesome. Welcome to Take Control of Your Tax Season, Physician Tax Tips and Expanded Support. I'm Amber, Marketing Manager, Earned. I'll be your moderator for today's webinar. Earned is the fully comprehensive tax and wealth firm built specifically for doctors, their families, and their practices. We bring proactive tax planning, investment management, retirement strategy, practice advisory, and legal coordination together under one roof so your entire financial life works in sync. With the addition of PearsonRavitz, we've expanded into special disability insurance guidance. And with OJM, we've further advanced our wealth planning model, strengthening our ability to deliver truly integrated physician-first advice at every stage of your career. Before we get started, a few quick housekeeping notes. The chat icon is on the right bottom corner of your screen. Feel free, say hello, tell us where you're viewing from. And also utilize this questions box right below to the left of the chat to enter any questions you have at any point during our presentation. We would be happy to answer those during our live Q&A session at the very end of our presentation. I want to share with you a little bit about what we're going to talk about today. Of course, we have Stephanie sharing why her advocacy led her to Earned and how we are expanding all our wonderful services to you as clients. Carole is going to join us and do our tax and planning strategies. And then we will share even more about the opportunities that you now have being a Earned client. And of course, we're going to finish up with making sure that all your questions are answered, whether that's about insurance, tax, financials, or even your integration into Earned. We are excited to have Stephanie and Carole on with us today. Stephanie Pearson, as many of you may know, leads the PearsonRavitz division at Earned. After practicing as an OBGYN, a career-ending injury revealed critical gaps in physician disability coverage, an experience that now fuels her mission to protect healthcare professionals. Combining firsthand clinical insight with deep insurance expertise, Stephanie advocates for physicians nationwide, helping them navigate complex disability policies, safeguard their income, and avoid costly mistakes. Carole Foos is the managing director of the OJM division at Earned, and as a certified public accountant with more than 25 years of experience in tax planning and financial consulting for physicians and business owners. She has a background that includes Big Four tax experience and years in public accounting. She brings deep technical expertise to her work. Carole is also a prolific educator and co-author of numerous financial resources, and she frequently lectures on tax planning and wealth management, helping physicians build and protect their wealth with clarity and confidence. I'm really excited to have them on with us today. With that, I will turn it over with Stephanie to really share about advocacy with us.
Good morning, everybody. As you know, Stephanie Pearson, OBGYN by training, and unfortunately got kicked in the shoulder during a difficult patient delivery, and she ruined my shoulder and my career. I learned a lot the hard way about disability insurance and life insurance, and really took my story and my journey, and really don't want the same journey to happen for anybody else. And of course, that was why PearsonRavitz was initially founded. I wanted to make sure that everyone understood what lives in their disability documents, what they're getting, what they're not getting. And I really believe that physicians deserve someone in their corner who truly understands what's at stake. I have found during many of my conversations that disability and life insurance isn't the only thing that physicians are a little bit confused about. Most of us are not really taught how to be adults. We're taught how to be amazing healers and teachers. But when it comes to financial literacy, it's somewhere that we really find holes. And one of the things is tax situations. And so multiple docs, it's a little bit different if you're in training and have one stream. But as folks go into their attending hoods, we find that some docs have multiple income streams. They may be buying practices. They may be really in a couple different places, real estate, et cetera. And tax law changes all the time. It's state regulated, it's federal regulated, and I didn't really have anyone to turn to help our clients. We also found that folks are really piecemealing their financial lives. And, I have my insurance broker here, my accountant here, my investor here. And it was a really nice opportunity for us to kind of come into one place and be able to offer that for people. And additionally, without good planning, docs were leaving a lot of money on the table, myself included. I've learned a lot since becoming part of the earned ecosystem. And again, kind of going back to why, we made this move, it's really that we wanted to be able to offer our clients additional service lines and really try to get everything and everybody under one roof. We wanted to provide good, solid care for our clients. Earned was built under the same value set, same mission of making sure that we can take care of physicians and make sure that you all are doing what you're supposed to be doing to maximize your financial health. They, like us, have a physician first focus, and we want to make sure that we are paying attention to the unique financial realities from residency all the way through retirement. We now have the ability, as Amber mentioned, to coordinate all of these services under a unified team that will allow for easy communication. This was an obvious, great first jump. We are getting into the thick of tax season as we were talking about where we should focus first. This just kind of fell in line as far as the calendar goes. So with that, now comes the important part, right? Taxes are often viewed as something reactive, something that you deal with after the fact, or you just let your accountant take care of it. But when approached strategically, they can really be one of the most powerful levers in your financial life. Carole is going to take you through, and you will gain insight into how thoughtful tax planning can create real opportunity, increase clarity, and help you keep more of the money that you have worked so hard to earn. Carole brings not only deep technical expertise, but also the ability to translate complex ideas into practical, actionable strategy. And I'm thrilled to learn along with you guys. So Carole, I'll turn it over to you.
Stephanie, appreciate it. And welcome everybody. Thanks for joining us today. We're going to talk about a few things in terms of items you want to be taking care of now as you're getting ready maybe to submit your information to your CPA for preparation of your 2025 tax return. A few things you can still do to hopefully lower your tax bill for 2025. But more importantly, some planning opportunities and things that you can think about and do as we move into 2026 to make your tax situation better. So what are some of the common pitfalls for physicians? Often, and I've worked with physician clients now in particular since I've been at OGM for 18 years, these are some of the complaints I hear, some of the frustrations. Underpaying estimated taxes. It's clients who come and say, oh my gosh, my CPA told me on, April the 3rd that I owe X amount of dollars. I don't understand. So as you're, maybe you change jobs, Maybe you got a great raise. Maybe you became an owner of your practice. Maybe you went from being, a resident physician to fully employed physician in a practice, and your income has changed. And perhaps, as I think a lot of people do, you weren't really paying attention to your withholding, or you didn't realize you should be making some estimated payments. So that can be an unwelcome surprise. This time of the year is the time to look at your 2026 withholding and think about 2026 estimated payments. Make sure that you're speaking to your CPA when you meet with him or her about 2025 taxes regarding any changes you foresee for 2026 that might affect this year's tax liability. Missing deduction opportunities is also big. So for those of you who have side income where you maybe file a Schedule C, or for those of you who are practice owners, we no longer can do employee expenses. Those used to be an itemized deduction. They're not anymore. But thinking about, your CME expenses, travel to that CME, home office deductions, if you're doing telemedicine or reading charts at your home office, car expenses, auto expenses, if you're going, from an office to the hospital during the day and things like that. Those are important to think about. Sit down with your CPA and talk about, are there things that I'm missing? If you work with a CPA who does a lot of other physician returns, they're often going to be able to tell you, hey, some of my other clients have these deductions. Are any of these applicable to you? So also ignoring state tax implications can be a problem in that, many of you might work across state lines, so you might have to file in multiple states. You might live in one state and practice in another state. So thinking about those things, especially if you've got a new job this year, you just want to be aware of what those state tax implications could be. So before you file, as you're thinking about your 2025 taxes, making sure you've got all of your 1099s and W-2s, that you've received those. Again, if you opened a new investment account this year with another brokerage firm, make sure you're giving that to your CPA. When I'm a CPA preparing tax returns, first what I'm looking at is last year's return to sort of make sure I have all the information. But I might not know about a new account that you opened, so I might not know that something's missing. Take a look at your prior year carry forward losses or credits and be aware of those. If you had some capital losses last year that you weren't able to take, those can carry over to this tax year. Even for some states, 529 deductions, if you put money into a 529 plan for a prior year and they were above that state's limit for a deduction, they will let you carry that forward to the next year. So thinking about those, again, typically your CPA is going to have a record of those, but if you change CPAs, if you moved, you're going to want to be bringing those to your CPA's attention. It's not too late to make an IRA contribution for 2025. A traditional IRA contribution or a Roth, you can do that up until April 15th. For some of you, you might be able to make a deductible IRA contribution. So again, mention that to your accountant as you're talking to them about 2025 tax preparation. Same thing with a health savings account contribution. You can do those up until April 15th. If you're above age 55, you can make an expanded catch-up contribution to your HSA. So make sure you're doing that if you've got a high deductible plan. And then if you've got that side income and you're filing a Schedule C or you're filing a return for that, make sure you're considering either that solo 401k plan or a SEP contribution. Again, those are deductible contributions, what I would call the low-hanging fruit of getting deductions against any of that business income that you have. So, I tell clients all the time, sometimes I have clients say, well, my CPA is not giving me any advice or, thoughts on this. You're right now getting into the worst part of the year for CPAs. And, as much as they try, things can get missed. So it's in your best interest to be proactive and bring the things up to the CPA or mention them and say, I'm interested in this. Am I eligible? Can I do it? So when we're thinking about this year, 2026, so next year's tax filing, what else should you be thinking about? Again, adjusting those withholdings if they don't seem appropriate. One thing that I like to advise clients to do as your tax preparer is getting your 2025 tax return ready, take in a pay stub for this year and let them project what your withholdings look like for 2026. So they're going to be able to help you know, are you withholding too much? Are you giving the government an interest-free loan by doing that? Are you withholding too little? And hey, you're going to owe a lot next year unless you increase your withholdings. So thinking about those things, think about your charitable giving strategies. We're going to talk about this later on in the presentation, but things like donor advised funds. If you are age 70 and a half or over, you can do qualified charitable distributions out of your 401k or your IRA. Consider what we call bunching deductions, meaning they've limited, state and local tax deductions, depending on your income level, to either $10,000 or $40,000. And they've raised the standard deduction. So for a lot of people, you're really close to that limit of whether you're itemizing deductions or taking the standard deduction. What we advise people to do a lot of times is what we call bunch your deductions, meaning, for instance, give 2 years of charitable contributions in 2026. So I'm going to itemize my 2026 deductions, and then I'm not going to make my charitable contributions in 2027 because I quote unquote pre-funded those. And so in 2027, I'm going to take the standard deduction. And I'm going to show you a slide later that's going to kind of walk you through how that works. Capital gains harvesting. This is something I see a lot. Stock market has been great over the past few years. If you are selling investments and you're realizing capital gains, which a lot of people are doing because they need to rebalance their portfolios, then it's important to also look and see, are there positions in your portfolio which are, if you sold them right now, would be at a loss? Does it make sense to do that, get rid of those positions now to offset the capital gains that you're realizing with capital losses? Vice versa. If it was time to sell an investment because it was in a loss position and you just didn't want it anymore, you can only deduct capital losses on your federal tax return to the extent that you have capital gains plus another $3,000. So if you did something that generated a large loss, and maybe it's a stock investment, maybe it's selling a property, an investment property, but then think about, I don't want to just not use that loss and carry it forward. Maybe that's a great time for me to generate capital gains in my portfolio to rebalance it. And I'm not going to pay taxes on them right now because they're just going to go to offset that loss. So working with your wealth planner on that is vitally important. And hopefully your investment advisor is proactive in doing that within your account as well. Another important thing when we talk about investment income is making sure that you've got the right assets in the correct accounts. What do I mean by that? If you've got a traditional or a Roth 401k plan or an IRA, I don't care how many dividends are generated in that account, because you know what you're not doing? Paying tax on those dividends currently. You're not paying any tax on those accounts until you're making withdrawals from them in the future. And for Roth accounts, you're not paying any tax at all because that growth is tax-free. So what I do care about is if you've got an after-tax brokerage account that's generating a lot of dividends and taxable income. And again, I'm not saying don't have any of that in your brokerage account, right? First things first, let's make sure it's a good, healthy investment and it makes sense for you. But to the extent that I can minimize the tax impact on my investment, what we in the investment world call the tax drag, that's going to make my investments grow in a better way, because I'm not paying taxes each year. I'm kind of kicking that tax can down the road. State tax deductible 529 plan contributions are a great way for you to save some state taxes and save for your child's college education. You know, many states offer either a deduction or a credit against your state tax for 529 plan contributions. In many states, you have to be contributing to that state's plan in order to get the deduction or the credit, but it can be, you know, a lucrative way to save some state taxes. So be aware of what your state's rules are. If you're not, ask your CPA, and think about that as another way. Again, not federally tax deductible, but in pass-through entity elections. So for those of you who have either a Schedule C or you're an owner in a partnership or an S corporation, the pass-through entity election has been instituted by most states that allows your entity, so your S corp, your partnership, or even your Schedule C, to elect to pay tax at the entity level versus paying that tax as an individual. What does that do? I mentioned earlier, for federal tax purposes, your itemized deductions for taxes are limited. So I'll give you an example. If I've got flow through income from my S corporation of $100,000 and my state taxes on that income are perhaps 6%, then I'm going to pay, right, $6,000 of state tax individually on that income. If instead, so now $6,000, if you're a high income taxpayer, you've only got another $4,000 of state and local taxes that you can deduct. So that means not all of my property taxes are deductible, as an example. If instead I made a pass-through entity election and now that $6,000 is being paid by my S corporation, it's now a federal deduction on my S corporation return. So if I had the same income next year, instead of having $100,000 of flow through income, I got that $6,000 deduction. So it's only going to be $94,000. I still have my full $10,000 limit on state and local tax deductions as an individual. So I just increased my state and local tax deductions from 10,000 to 16. Again, makes a lot of sense in a lot of states. That's something for sure to talk to your CPA about if you're not currently doing a pass-through entity election and it is available in your state. Backdoor Roth conversions are another planning opportunity for wealth, and we use these in several different ways. What I mean by a backdoor Roth conversion, if you're not familiar, many of you make too much money, your income is too high to directly contribute to a Roth IRA. Now, there is no income limit for a contribution to a Roth 401k, so you may very well be able to contribute to a Roth 401k. What you can do is you can make a non-deductible IRA contribution this year, and then you can convert that IRA to a Roth IRA. So let's say you made a $7,500 IRA contribution, you didn't deduct it. When you convert it to a Roth, there's no tax impact of doing that, likely. And therefore, once you've converted it to a Roth, all the income that comes into it grows tax-free and comes out tax-free. One caveat to that, if you have other IRA accounts, including a SEP IRA, that conversion will not be fully non-taxable because the IRS considers all of your IRA accounts as though they're one account. So when I made that non-deductible IRA contribution, right, I'm like, okay, I paid tax on that already. I don't have to pay tax on the conversion. But if I've got other IRA accounts where I have had a tax deduction, or I've rolled a 401k over into that IRA, so I've never paid tax on that money, you're going to have some pro rata tax on a Roth conversion. A little complicated to get into today, but just be aware of that. Talk to your CPA about it. Again, sometimes even if you're paying a little tax on the conversion, it might still make some sense. And we're going to talk about that in a few minutes regarding tax diversification. An important thing for you to consider if you have side income, if you own a practice, how is your entity structured? So, right, a sole proprietorship, we're talking about filing Schedule C on your individual tax return. It's kind of the simplest way to do it. You're not filing a separate tax return. If you're just a sole proprietor and you have not set up an LLC, what I would tell you is you've got full personal liability. You can be taxed as a Schedule C, but still set up a single member LLC. I think we would pretty much always advise that, just in terms of limiting your liability. But the sole proprietorship, also, you're paying full self-employment tax on your net income, okay? An S corporation and a partnership, both of those are what we call pass-through entities. So those are eligible for that pass-through entity tax. If you're an S corporation, the profits from the corporation are flowing through to your personal tax return. You're paying tax at ordinary income tax rates. You're taking W-2 wages if you are providing services to the organization, but you do get savings on Medicare taxes because those profits that flow through to you are not subject to Medicare tax. Your salary is. Okay. Partnerships or an LLC taxed as a partnership can have some great benefits in terms of there's a flexible allocation of expenses among the partners. You've got limited liability, especially in an LLC, multiple members. Partners. Sorry, I just lost my internet connection for 1 second somehow. So hopefully you heard that, most of that. C corporations are for small businesses or, businesses with a few owners. You do have the risk of double taxation. A C corporation's net profits are subject to 21% corporate tax. In addition to that, the salary that you take out of your C corp or any dividends that you take out are also subject to tax. Most small entities taxed as a C corp are avoiding that by bonusing out the income to the owners. So that's what, there are ways to get around that double taxation, but you do have to plan for that, and you have to do some year-end planning to make sure you're not subject to double taxation. Here's one of the things that we have preached as a firm for many years. Tax diversification is really important. So think about this much like you're thinking about diversification of your investment portfolio. There are sort of 3 different ways that assets are taxed in this country. Ordinary income tax, right? Top tax rate right now is 37%. Your salary is taxed in this manner. Your flow-through income from your businesses is taxed in this manner. Interest income, generally. 401k distributions, IRA distributions from traditional 401ks or IRAs are taxed at ordinary income tax rates. Your capital gains bucket is going to be that after-tax brokerage account. It's going to be when you sell your practice or when you sell the building that your practice is in or sell other assets, right? Long-term capital gains rates right now top out at 20%. If you're in the highest tax bracket, they're at 15% if you're not in the highest tax bracket. And then there's a bucket of money that's tax-free. That's going to be I don't know what's going on with my internet, so I apologize. Tax-free income will be your Roth accounts. It will be your municipal accounts, so municipal interest, right, is tax-free. It's also going to be things like, for many of you, you might have put money into a permanent life insurance policy and are withdrawing or borrowing from that as part of your tax-free income. We like to see a mix of assets in all three of these buckets as you're approaching retirement. Why? We have no idea what tax rates are going to be in the future. So they could be higher. They're right now the fourth lowest top tax rate in the 100+ year history of the Internal Revenue Code. So we know those could go higher. And what we want to see is you having the ability to take money out of these different buckets to plan for your tax rates in the future. So what are some strategies for reducing tax-related investments if you're able, right? You can always donate cash to a charity, but if you have appreciated stock that you can donate, and most charities accept stock donations, what you can do is donate that stock. You get a deduction for the fair market value of the stock at the date of the donation, and then you never pay capital gains tax on that investment, on the gain. So as an example, I have $10,000 of Apple stock, $100,000 fair market value of stock that I paid $40,000 for. If I sold that stock and then donated that $100,000 to the charity, I would have $60,000 of capital gain that I'm either going to pay 15 or 20% capital gains tax on, plus some state tax. Instead, I donate the stock to the charity. I get the full $100,000 as a deduction still. I avoided paying tax on that $60,000 of capital gain. And I can now take my $100,000 of cash and put it back in my investment account to buy other stocks. Donor advised funds are another great way to bunch donations or to sort of pre-fund future donations. We often work with clients on this, particularly if they sold an asset, sold a building, sold a practice, right? But it doesn't have to be in that situation. You can, as I mentioned earlier, do 2 years of charitable donations in 1 year. If you still want the charities to get them over the course of the 2 years, you can put them into a donor advised fund, and then you advise that fund to donate half of the money this year and half the following year. And then you can do it again 2 years from now, build up your donor advised fund again. It's basically a charitable investment account. So once you put the money into the donor advised fund, that's when you get the deduction. You direct the fund as to what charities you're going to contribute to. They're writing the checks to the charities. Obviously, you're not then getting another deduction once the money goes out. But it does allow you to schedule the donations on your time. And it also allows you to, those investments can earn money over time. So your donor advised fund can grow. And since it's in a donor advised fund, the growth on that fund is not taxable. So it's a very tax efficient way to make charitable donations. And it's something that has become very popular and useful across all sorts of, income levels of taxpayers. Here's an example of a donor advised fund in action, and I love this example. So this is a hypothetical taxpayer who makes it over a 6-year period from 2025 to 2030 of 1,800. Taxes paid as itemized deductions on the return are
Hey everyone, we're just having some issues with some internet. Thanks for sticking in there. I'm going to have Carole basically turn off her video and keep talking, and then she'll rejoin us.
6,829.
Hey Carole, thanks so much.
Yes.
Yeah, we're cutting out. Go ahead and
So
just turn off
sorry.
your camera, and then you
Okay.
keep talking. Yeah. And that might
Okay,
save our
perfect.
internet a little bit.
That'll,
Perfect.
okay, we'll do
Keep
it.
going.
Got it.
You're doing great. Thank you so much.
Okay. Paying taxes of $6,887 each year and taking that as an itemized deduction, as opposed to the standard deduction of $29,200. Now, that was the standard deduction for 2025. It's gone up to $31,500 this year, I believe. But anyway, net deduction on the taxpayer's tax return, $51,748 each year. So the total gift that the taxpayer made over the course of the 6 years is that $269,166, and the total deductions taken $310,488. If instead the taxpayer bunched those gifts and gave $89,722 every other year, took the standard deduction of $29,200 in the off years, you can see they still made the same gift of $269,166, but their total deduction increased to $377,427. So huge increase in their total deduction. Great way to bunch your deductions and see an additional, $67,000 deduction from taxable income. Qualified charitable distributions, I mentioned earlier, only available for taxpayers age 70 and a half or older, and the money has to be donated directly from IRAs to a qualified 501c3 charity. So it can't go to a private foundation, right? It's got to be a 501c3 charity. What this does and the way it works is up to $108,000 per individual or $216,000 per couple can be contributed. It reduces your required minimum distribution. So for those of you who are 70 and a half and don't have to take required minimum distributions till 75, doing these qualified charitable distributions reduces the balance in your IRA and thus reduces the amount that you will have to give once you have to start taking required minimum distributions. Once you do have to take those required minimum distributions, this counts against it. So if my required minimum distribution was $200,000 and I elected to do a $108,000 qualified charitable distribution, now my required minimum distribution is only $92,000. Again, for those of you who are saving more in your retirement plans than what you will need to live on, this is a great way to control your tax bracket and control your tax rate in retirement, which is what we love to see. So before you give, there are some items on the screen that can help you know, is the charity eligible? Where do I find that out? Again, 501c3 organizations. So think about churches, schools, cancer society, things of that nature. There is an IRS tax exempt organization search that you can go to find out. And again, these cannot go to those donor advised funds that we talked about before or to private foundations. Here's another, what I find to be fascinating tax planning tool, custom indexing, which, when we're talking about investments, and this is a great thing to work with investment advisors on, it allows you to own individual securities that would typically be bundled in an exchange traded fund or a mutual fund, but it enables you to tax loss harvest in those securities to offset your capital gains. What do I mean by that? Here at Earned, we use technology to capture tax losses through this direct indexing. So you're kind of banking your losses to offset gains that you might have in your account. As an example, if I sold a building this year and I'm going to have a large gain, using this type of direct indexing can help me realize losses in my investment portfolio to offset that gain. And the great thing about it is you're still doing it with a healthy investment portfolio. So it's generating more taxable losses in all market conditions. It helps you more rapidly offset capital gains. Again, sale of a practice or a property, whether that's happening this year or that's going to happen in a year or two, there are ways to build up losses so that you've got losses to offset those taxable gains. And when we think about that in action, this is a real case study. So it's an earned client, 67-year-old orthodontist in California, received about $400,000 in annual income from the practice. So you can see that the wealth advisors use tax loss harvesting to get losses throughout the year, and then sold the practice and realized capital gains, but ended up with a very small tax liability. So in this case, 1.7 million was funded into an account with his earned wealth advisors in 2023, sold the practice in June of 24 for 1.6 million, and invested 1.1 million more, and harvested a total of 1.4 million losses in 2024, which saved about $420,000 in taxes. It's very powerful. It's something that we're going to give you some, information later to contact if you've got interest in strategies like this for tax loss harvesting. It's a great way to talk to some of the earned wealth advisors and learn more about it, as they can certainly explain it in a better way than I can. But what I can tell you is the power of this tax loss harvesting is huge in terms of saving those tax dollars. And if you think about it, an extra 1% of tax alpha, so saving taxes 1%, can add up to an additional 11 years of retirement distributions. Really amazing when you think about, building your wealth for retirement. I think one of the important things that I will tell you is coordinating tax planning with your long-term goals is really important. And as you've seen across this presentation and this screen, what we want to work together on is tax strategy, wealth planning, and risk protection. Working all of those themes together to do an annual review is really important. And what I mean by that, right, I mentioned earlier when we're talking about investments, and whether that's generating losses to offset gains or whether it's putting money in each of those buckets for tax diversification, we don't want to do anything just for a tax strategy or necessarily just for an investment strategy. We want to coordinate those plans along with risk protection. So along with making sure you've got proper insurance coverage, making sure your assets are protected and owned in the proper ways. All of this coordination is one of the most important things in achieving your wealth goals. It's not about just finding an advisor who sort of only has, all their tricks are tax tricks or all their tricks are investment tricks. You want all of your advisors to work together on a coordinated strategy across this ecosystem. Here's what, why I think having an integrated approach matters. It's why we are part of Earned. So a CPA might recommend maximizing your 401k contributions or doing a cash balance plan to get more contributions. And then you might have a financial advisor who's suggesting Roth conversions. So these can be conflicting strategies, and we don't want that. We want a coordinated approach across tax and investments. Here at Earned, we have the tax specialist and the wealth planner collaborate, day in and day out, sequencing the Roth conversions in lower income years and then coordinating the 401k and cash balance contributions in higher income years to align the entire strategy and ultimately to build your assets across those three buckets of tax diversification in a manner that's going to increase your long-term wealth goals or, make you achieve them easier. So it's not about having necessarily each separate specialized individual advisor. It's about having an aligned approach and making sure your advisors across these spectrums are communicating with each other. I'm going to turn it over to Amber now to talk about our financial team.
Awesome. Thank you so much, Carole. Wow, such great information on taxes and wealth and how that coordination comes together. Really appreciate all your insight on that. And again, if anyone has any questions for Carole on a lot of those deep dives for tax, she's happy to answer those. You can put your questions in the chat box, and then you'll be able to see her contact information in a second. But like she said, right, here at Earned, we are an integrated financial team, right? We do not want you siloed. We want everything working together. Your insurance broker, your advisor, your lawyer, everything works together in a perfect way so that you are not overpaying taxes and you're not missing out on things that can save you money and build you a better future. And so you as physicians, right, you deserve better. We are the first fully comprehensive tax smart wealth management for you and your practice. Whether you are a practice owner or not, this still applies to you as a W-2 physician, 1099, any types of income we can help with. We do our wealth management. We give you financial planning guides. We handle investment strategies. If you need trust and estate planning, again, we want to help advise you through your career and help you build a long-lasting career that eventually brings you to retirement and you're retiring pretty, right? We want to make sure that everything that we do is getting you to where you want to be. And that now includes with PearsonRavitz, the insurance component, right? You came on to PearsonRavitz because you appreciated Stephanie's approach. You appreciated her willingness to make sure that you were covered and protected. And we want to do the same thing for you in all aspects of your financial health. So again, whether you own your own practice, whether you're a W-2 physician, whether you're a 1099 contract work, it does not matter. We can help you. And that leads us to making sure that we have the best team for you. And we do. We have a wide variety of experts in their craft. And these are just 3 of the people that you get to meet with when you expand your services with Earn. So Stephanie, as you well know, was on the call earlier today. I'll bring her back on so we can dive into a few questions. And then again, Carole with a tax and wealth tips. And as you can see on the screen, Trevor is from our client development team, and he is happy to answer and make sure you get exactly what you need for all your questions and services. So Stephanie, thanks for joining us again. We are really excited that, PearsonRavitz and OJM have, combined with Earned and are offering so much more. We want to handle a few questions, and I have a question for you. How do you see when you are, dealing with your everyday clients and they're asking for insurance? Do they come to you for other factors? Are there maybe other instances that they're, things aren't coordinating correctly and you really need to kind of dive deeper into different types of insurance or services that are uncoordinated?
The short answer is sure. I mean, we get asked often if we know other people, right? And so for years, we've either been able to send referrals or we've had to say to somebody, we're really sorry, we don't know anyone in that space. And so now it's nice that we have the ability to offer it within the entire ecosystem.
Thank you. Yeah, I appreciate that. Carole, a tax question for you. When it comes to, maximizing 401k or even 403b, how does that look kind of across different types of incomes tax-wise? based on like maybe 1099 or W-2 physician or a practice owner. Do you mind expanding on that?
Yeah, sure. So I think a few things that people need to keep in mind, and I'm glad you asked that because I didn't mention it earlier, but as an example, if you're an employee and you're able to, or even an owner of a practice and you have a 401k plan, right? Or you're at a hospital, you have a 403b plan, you can maximize your contributions to that plan. And if you have that side income and you're getting Schedule C income, you can still do a SEP contribution because a SEP plan is considered an employer contribution. So you're still able to do that even if you've maximized your salary deferrals into a 401k or a 403b. Similarly, you could do a 401k solo 401k plan with that side income, and do a profit sharing contribution as the employer. So those are important things to understand. Additionally, I think, what we've been talking to clients about a lot is also if you've got, as an example, one spouse can do 401k contribution and maybe has a cash balance plan or some sort of defined benefit plan. Another spouse also working has the ability to contribute to a 401k or 403b. Think about, does it make sense for one of you to have some of your contributions, some of your salary deferrals go into a Roth account? Because again, that's a great way to start building that tax-free bucket. And even though you're giving up some current deductions today, what we have found over many, many years working with physicians is that high income earners, while your tax rates might drop in retirement, they're not dropping a lot, guys, especially in the early years of retirement. So really important to have assets in each of those buckets, and putting some money into your Roth 401k or 403b is a great way to do that.
Awesome. Thank you, Carole. We actually have a question from one of our audience members. I'm going to put it on the screen for us to answer. So it says, I make 1099 income paid through PayPal. I got a K-1 from PayPal and a 1099 from the clients that pay through PayPal. Am I getting double taxed?
So that is something that you definitely need to, your CPA can correct that on your tax return. You're going to want to give the CPA both of those items, explain that it is the same income. Yes, technically the client should not have sent you a 1099. The other thing that you can do is reach out to the client and say, hey, these third-party payors like PayPal are now required to report this income. You are not. So two options: the client can issue a corrected 1099 and show that they, your income from them was zero because the income actually came from PayPal. Otherwise, if they don't want to do that, they can't do that. It's an uncomfortable conversation. The other thing is the CPA can report both so that there's no issue with matching and you don't get a notice from the IRS, and then show the double payment as the deduction against the 1099 income. So a couple ways, but I would definitely reach out to the client and say, hey, FYI, PayPal also reported this. So
Thank you, Carole. Yeah, that's a great answer. I think hopefully, Ricky, that helps you with that conundrum that you're in, and we can get that handled for you. Someone was asking, do you have a CPA and can you provide accounting service? The answer is yes. We are a group of CPAs and we do tax and accounting, payroll, retirement, now insurance, legal, you name it, we do it. That's why we're the one-stop shop. So I put that book your free consult button. This is the best way to get connected with one of our CPAs and get you those accounting services that you need. Another question coming in. I have a side gig with 30K of 1099. What app or AI would you recommend to keep track of this expenses? And actually, before I might jump in on this one, we actually have a earned app that will help you do that. So if you go onto Apple iPhone store, you can type in Earned Wealth and you will find our Earned Financial app, and that will help you keep track of your expenses. And Oksana, I will happily email you the link to that as well. But are there any other tools, maybe Carole, Stephanie, that you also use besides the Earned app to keep track of your expenses? Maybe you're a pen and paper person. That
I think, QuickBooks is one, but again, it kind of depends. How much activity do you have? Might not be worth it. Certainly just an Excel spreadsheet. I do recommend to people get a separate credit card for those business expenses. That keeps it easy, and only use that credit card for the business expenses, because then you've got a great record to provide to your CPA at the end of the year. But as Amber said, that Earned app is pretty impressive, I think. So definitely take a look at that and see if that works for you as well.
awesome.
I was going to say the exact same thing as Carole. We use QuickBooks, but again, it depends on how aggressive and how many things you're doing. And obviously the Earned app may be better for somebody with only one small side gig.
Mhm.
Yes.
Wonderful. Thank you so much. Well, we are wrapping up here today with our Take Control of Tax Season, physician tax tips and expanded support. I just want to say thank you, Carole and Stephanie, for bringing your expertise, bringing your stories, answering our questions for today. And again, if there's any more of the questions that come in, we are happy to answer and make sure that you get all the answers you want and the services to make your life easier and your financial life work together. So again, thank you, Stephanie and Carole, and we will see you guys next time.
Thank
Thanks
you.
for having us. Bye.
Yes.